The other side of the trade is someone who writes that contract, who sells you that contract. And that person believes that the price will be lower than in the future than it is at the time that they write it. And that's how they make their money. So you have one person on one side of the contract who believes that the contract is going to be more valuable in the future. You have a person on the other side of the contract who writes that contract who believes that the value is going to be less in the future. But it's not that one-dimensional. The fact is, the person who writes you that contract, who sells you that contract, may also hedge that contract with other options. So he may go into the market and place a corresponding trade on another option that hedges his risk in case he is wrong, and that contract actually goes up in value rather than down in value. So as an option buyer, you also want to be able to hedge your bets. One thing about being an option buyer is that, in fact, there's only really two absolute rules when it comes to being an option buyer. Number one is your contract will fluctuate in value. Number two is that contract will expire at some future date. Those are the only two absolute rules of options. Again, those rules are: number one, it will fluctuate in price. Number two, it will expire at a future date. If you think of options only as a contract, you're simply buying and selling different contracts. And you're betting really on the future value of that contract. It's been said a lot of times, and I know it's absolutely 100% sure and absolutely true that the stock market and the option markets is the biggest casino in the world. And it's right, except for one thing. When you go to a casino and you place a bet, let's say you go to the roulette wheel and you place a bet on black, let's say you bet $100 on black, and it comes up red, well, you lose that $100. You don't get that back. You lose 100% of your bet. In the stock market, when you place a bet, let's say you buy an option contract, well, number one is the price will fluctuate. That's the number one rule. The price will fluctuate. So what will happen is you can place a bet, a $100 bet on an option, and 3 days later, let's say the price has gone up. Well, not only do you get back your original investment, but you also make a small profit on that, or you may make a large profit on that. But you get back your original investment plus a profit if the price goes up. If the price falls, well, you get a portion of your investment back. You were totally wrong, but at least you get some of your money back. In the casino, if you're wrong, you don't get any of your investment back. So that's the major difference between the stock market and a casino, is that when you place a bet in the stock market, if you decide that you're very, very bullish on a particular stock, and you buy a call option that hopefully will increase in value as the stock increases in value. And if you're totally wrong and the stock falls, you can get out of that contract with at least some of your money back if you act prudently and quickly enough before expiration. So that is the major difference between the stock market and a casino. Now, what happens if so you have two types of options basically. You have the call option, which allows you to purchase a contract that gives you the right to purchase the stock at a particular stock price in the future. And then you have a put option, which is also a legally binding contract that allows you to the right, but again, not the obligation, to sell a particular number of shares of stock at any time in the future before its expiration, whether or not you own the underlying stock. And they may get a little confusing, but let's use this analogy. Let's say you own a home. Let's say you own a home, and you don't keep track of the market very well for your home, and other houses in the market, have sold recently, or they were sold in the past, and you had no idea, you didn't keep track of what they sold for and what prices people were getting for them. And someone knocked on your door one day and said, "You know what? I like your house. Would you be interested in selling it to me?" And you say, "Well, it depends, Look, I'm interested in buying your house for $1 million, but I'd like, what I'd like to do is say, I'm not really sure if I can get the financing or whatever, and I'd like 90 days to decide. But within that 90 days, I'd like the option to be able to purchase your property for $1 million. In exchange for you holding that property for me for 90 days, I'll give you a $500 deposit. And whether I buy the property or I don't buy the property, you get to keep that money." And boy, if you were the owner of that property, and you know that you only purchased that property for $300,000 just a few years ago, the prospect of actually selling your property for $1 million might be very attractive to you. So you enter into a contract with the person. He gives you a $500 deposit premium on the contract to hold the property for 90 days, and if he decides to exercise that option to purchase your property for $1 million, you'll have made a $700,000 profit. Now, the person who owns the contract, who wants to purchase your property, knows that there is a huge development going on near your home, and they're putting in, some super duper shopping center, and all of a sudden your property values are going up tremendously because this is a great place, and there's a resort going in there, and all of a sudden the properties in that area are going to double and triple in price, and you didn't know anything about that. So you took his $500, and now if he does not decide to come back and buy your property for $1 million within